the final financial crisis, at least in my opinion, what will be the final financial crisis, is still slated to come this year. I'll show you two triangulating charts that suggest this, don't prove it, but suggest that we are still on track for a financial crisis by the end of this year, which will lead to the next money printing round. By extension, should lead to stagnant stocks and a rising gold and silver price, very much like the 1970s, which was actually worse than 1930s in terms of stocks relative to gold and silver. Because remember, in the 1930s, the dollar was gold. In the 1970s, it wasn't. We have a huge triangle in gold to stocks ratio that is going to break out in the next few months. And we're going to take a long-term look at the gold stocks ratio and what I call the bikini of doom force.
Good evening, everyone. Tonight, we delve into some pressing developments in the financial markets that could signal major shifts in the months ahead. Financial analyst Rafi Farber warns that a significant financial crisis is on the horizon, potentially unfolding before the year ends. Farber suggests that this looming crisis will trigger another round of aggressive money printing by central banks, leading to a stagnation in stock markets and a surge in the prices of gold and silver, reminiscent of the economic turbulence of the 1970s. Let's start by examining the critical signals pointing to this crisis. Farber highlights a substantial triangle formation in the gold to stocks ratio that has been developing over the past few decades. He notes that stocks have been losing ground relative to gold since the year 2000, and this trend is likely to accelerate as we approach the year end. According to Farber, the charts indicate that the stock market may face severe declines, while gold is poised for a breakout, potentially mirroring the dramatic price increases seen in the 1970s. He intriguingly refers to this as the bikini of doom, a visual metaphor that underscores the gravity of the situation for stock markets. In addition to the gold market, Farber discusses silver, emphasizing that the metal is also on the brink of a significant rally. He cites a Bank of America report that points to a growing deficit in global silver inventories, which have been declining steadily over the past 5 years. This decline is attributed to increased demand, particularly from China.
All-time high. Other than those exceptions, this is the major resistance, and we're coming onto it for a fourth or fifth time, depending on how you count it. And now we are coiling off the 200-week moving average. I do think we're going to break through this resistance finally, not for any lockdown reason or for any spectacular bull top reason like we had in 2011. I just think silver will continue to climb until it catapults in a monetary crisis, which is coming up in the next few months, in my opinion. But let's move to the gold to stocks ratio. We see here that we have a major triangle that has formed since 2000 here. The lower this goes, the higher gold relative to stocks, the lower stocks relative to gold. And we can see here that stocks have been falling relative to gold pretty spectacularly since 2000, 1999, 2000. And we're going to break out of this triangle, I think, lower. And we should head past the low here, which is somewhere between 1 and 0. I don't know exactly where, but we are going back there. This is a longer term chart of this thing over here. This is the same chart going back to 1900. No, not exactly the same. This is the S&P 500 and this is the Dow, but it's basically the same chart. I think I have the S&P in the next slide, so you'll see that too. You can see here, this I call the bikini top of doom for stocks because why not? This looks like a bikini top or glasses, but bikini top just sounds better. I know they're not even, but you know, they never really are perfectly. So we have here, it looks like a triple move where we had lower highs going in the 1960s and 1970s of the Dow relative to gold. And then we had a major top here in 2000 that we've never even gotten close to. And now we have like an echo bubble of the same sort of pattern of lower highs. One here, one here, one here, and it's continuing to fall. So I do expect that we will get to the 1980 lows here, which are reflected in 1931 lows over here, slightly lower than that. But this ratio is headed down. I think this top here is not going to be repeated. It means that stocks are going to fall hard relative to gold and harder relative to silver, though silver will catch up at the end, as it always does. This is the S&P 500 relative to gold. Sorry. So the lower this goes, the lower the S&P 500 goes relative to gold. And you can see a very similar chart here of lower highs and head and shoulders. And this is also a bikini of doom. And now, I said in the introduction that I would explain why I think that the end of the year is still ripe for the final financial crisis, which will result in the final printing round, which will be bigger than 2020, which was bigger than 2008, which is bigger than 2001, etc. So here we have a chart from a friend of mine, a subscriber to the Endgame Investor on Substack, Dr. John Gideon Hartnett, who Chris has also spoken to. He's a physicist and a very wise man. It says here, I titled it, even if QT stops completely, that takes us to February 2025. I'll explain this chart in a second here. So this curve here is a double exponential. What Dr. John Gideon Hartnett did was he plotted Fed liabilities going all the way back to 1913. This is one section of that graph, and found that the liabilities had to plot a double exponential curve. This is number 2 here, as you see. And every time that the Fed falls below the curve a certain amount, you have a financial crisis. And we find that point to be, in 2019 during the apocalypse, 36% below the double exponential curve. And the Fed went back above the double exponential curve during the 2020 printing round. And when it went below it again, there was a minor regional banking crisis. And now we're headed towards the 36% below crisis line over here. And had QT, this was the line of the trajectory of QT from the time post-regional banking bailout until now. If it had continued on the line that it did, you can see QT slows down slightly over here. Had it continued at the rate it had gone post-regional banking bailout, then we would have hit the 36% below crisis line at August 31st, 2024. And now we're slightly below that rate, so it's going to stretch out. And what I did was I added the calculation that even assuming QT completely stops, meaning the amount of liabilities stays the same on the Fed's balance sheet, or the assets liabilities, same thing, we will only be able to stretch out to about January, February 2025 until we hit the next crisis. Why? Because the double exponential continues to move higher and higher, and the Fed's liabilities must match that. And if they stay stable, we only have a few months left until the next crisis anyway, even if QT completely stops. So this is
where silver consumption is surging due to the booming solar energy sector. Farber explains that as silver inventories dwindle, the market deficit is starting to make a noticeable impact, with further shortages expected in the coming years. This situation is likely to drive silver prices higher as supply struggles to keep up with demand, particularly as governments around the world push for more green energy initiatives by 2030. Now, let's consider the broader economic implications. Farber draws a comparison to the 1970s, a period marked by high inflation and stagnant economic growth, known as stagflation. He argues that while the stock market may not experience a catastrophic crash like in the 1930s, it could see prolonged stagnation, with stocks fluctuating within a narrow range, but losing significant value relative to gold. He also points out that in the 1970s, while the nominal value of stocks didn't collapse, their value relative to gold plummeted by 94%. Farber warns that we could see a similar scenario unfold, with stocks ultimately being worth much less in real terms, even if their nominal prices remain relatively stable. Looking ahead, Farber's analysis suggests that the Federal Reserve's current policy trajectory could lead to another financial crisis by early 2025. He references research by Dr. John Gideon Hartnett, who plotted the Federal Reserve's liabilities against a double exponential curve going back to 1913.
And the repo volume keeps rising every week. We are now at an average of about 2.1 trillion for the week, and next week it should be even higher. And reserves are steady, but even if they are steady, if repos keep rising, then this ratio keeps rising as it has. I think we're at 64% now. And if you extrapolate this line out, we only have until about December, January 2025 until we hit the crisis level of 86-87% as we did during the apocalypse over here. So same sort of time frame, late 2024 for the next crisis when we hit 87% on this, which is the same as 36% below the curve of Fed liabilities on the other chart. It's all triangulating to the similar time frame. This is from Daniel Oliver's latest research that you can find at mermccann.com. and he is my favorite gold and silver analyst, as you would know if you've been following me for any amount of time. So what Oliver says here is that the 70s stagflation was actually worse for stocks than the 1930s, and actually as good for gold, but in a different way. The 1920s bubble was simply a credit bubble. There was no monetary debasement. The S&P 500 crashed 88% in nominal terms from peak to trough. That's 1929 to 1932. In the 1970s, the S&P 500 from its peak to 1967 to its trough in 1980 fell only 14% nominal terms, but 94% in terms of gold, which is much worse than it fell in terms of dollars, which is also in terms of gold in 1930s. If we are living through a repeat of the 1970s and the parallels seem so perfect, we should not expect a cataclysmic collapse in the stock market, despite the ridiculous valuations. Stocks would instead lurch higher and lower within a trading range for the next decade, ending in roughly the same nominal price but worth 90% less. Gold, on the other hand, will reveal the carnage. It rose 24-fold from 1971 to 1980. The way we look at it, gold went from being 12% of the Fed's balance sheet to 133% in the final dollar panic. The gold currently represents just 8.8% of the Fed's assets, so it would need to jump to 36% to 3,300 just to get to the 1970 low. So if we're talking about a 24-fold increase, as we saw in the 1970s, a 24-fold increase from now, because we were below where the low was in the 1970s, would be what? 2,500 times 24? I don't even know what that is. I can't really do the math so quickly, but do it yourself. 2,500 times 24. That's the high we need to get to just to reach the 1980 high in today's terms. And next, I want to go into the CPI. Why is it falling at 2.9% annual? It's, there's still price inflation. We're still at 3%, which is above the 2% Federal Reserve mandate or whatever it's called. So you can see here in the list, if you go to used cars and trucks, right, that's pretty much the only thing that's really falling. 2.3% month over month. And if you go here to the year over year numbers, you have almost 11%. And why is this? Well, you had huge supply chain disruptions during the lockdowns that took several months to clear out, and they're clearing out now. So if assuming you're not buying any used cars, inflation for you, or price inflation rather, is much worse, as it is for almost all of us. So yeah, used cars.
Nobody comes down.
See here in the CPI, measuring price change, inflation in the CPI, used cars and trucks. So how do you do this? How is it calculated? Well, you look down here and you see here's the equation: depreciation adjusted price equals P to the T to the M comma V times all this stuff to the N over 12, where PT to the MV is the price of the period T for making the model vintage thing. And then if you all carry that over the one and something, you can come up with the equation that will solve all of life, the universe, and everything. Not over. We had the Japanese Prime Minister Kishida, I think his name is. He resigned. Where did he resign?
According to this analysis, whenever the Fed's liabilities fall below this curve by a certain margin, a financial crisis tends to follow. Farber warns that we are once again approaching this critical threshold, and if current trends continue, we could see another major crisis unfold by late 2024 or early 2025. In conclusion, Rafi Farber's outlook is one of caution and preparation. He urges investors, particularly those holding significant positions in stocks, to consider reallocating their assets into gold and silver. According to his analysis, these precious metals are set to outperform in the coming months as the global financial system faces renewed pressures. The message is clear: while the exact timing of the crisis is uncertain, the underlying risks are substantial, and those who act now may be better positioned to weather the storm. Stay tuned for further updates as we continue to monitor these developments closely.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.